Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching. Please subscribe and please comment. This is number 6 in a 6-part series on the airlines, and I highly recommend you go back and watch each of the last 5 videos in their entirety. I went through the detail of each company, all but quickly, but to give you a basis on where the next information is going to come, and it's very important you do watch that. So here in this channel, remember, we're hunting for the intrinsic value of a company, and we're going to look for 5 key attributes for a business: top line revenue growth, earnings growth as we define it by EBITDA, free cash flow growth, low debt or a solid balance sheet, and low priced stock. We're going to run through all 5 characteristics for these 5 airline companies and see which one, if we had to back, would we back as the best performer for the future. Now, one giant caveat here is that we are in the middle of the hopefully the end of the coronavirus pandemic, and it's really affected the airline business. All of them are basically dependent on government bailout. If they don't get that bailout, they will go bankrupt. They need private money, meaning long-term debt from investors. They need possibly equity, which would be dilution to common stockholders if you bought the stock today. Some of the debt that they're taking on does have warrants in it and will have dilution automatically. And if they don't get the government loans, they're going to go bankrupt. So I think in any case, you need to look at this as a binary outcome. Either they recover and the industry and they were able to grow and hit their intrinsic value, or they go to zero and it's worthless. So when you invest in the stock, keep that in mind, that there's a real risk here of losing everything. All right, let's take a look at it. One last thing on the forecast. So what I've done is I've assumed an industry forecast that I've applied to all 5 stocks, and we'll see if they hit it. But basically using industry averages for yields and market multiples and a growth rate, which is very mild, to come up with future values for all of them, and we'll judge their current prices based on that future value. And see what the balance sheet looks like to see if they can weather this current storm. All right, so we're going to go through the 5 metrics now. I put some color highlighting here to call out basically the top in green and bottom in red. If you get a red, I think that automatically drops you from consideration. The green is just pointing out the stronger 2 of the 5 candidates. So let's take a look at revenue. Revenue here across the top. I'm going to follow the format on all of them. You've got Delta, Southwest, United, American, and JetBlue. For growth, for revenue, it looks like JetBlue is the leader and basically tied Delta and Southwest 3%, which is above inflation, but it's not the 1% for American, which is flat, and United actually had 2%, which is inflation. One comment on American. Again, because of the bankruptcy in 2011, I'm basically picking up around 2015 as a stabilized kind of post-bankruptcy level to see what they did from that point forward. So all these measures are basically this 5-year period of time, not the full 10. All right, that's revenue. Looks like our top performer was JetBlue, but Delta and Southwest are a solid kind of runner-up. Going forward, EBITDA, again, cash flow is based on what we look at. EBITDA is a proxy for cash flow. A bad one because it doesn't have CapEx in it, but nonetheless one that is used in the market. JetBlue, 10% EBITDA growth, solid, but Delta and Southwest outperform. I basically put anything in the double digit I would say is good, but I said I would only pick the top 2 to highlight, and so we're highlighting Delta and Southwest. Let's take a look at free cash flow. So this is free cash flow in total, not per unit share or yield. I just want to look at the magnitude of the free cash flow. And I'm highlighting the last couple years. Here it looks like both Delta and Southwest are positive and strong. United is there, and so is JetBlue. So very good. I'll also point out that it looks like in 2011 the entire industry had a hard time with the airline business and took them many years to recover. So I think this bodes well for my assumption that you're going to have zero cash flow to equity holders in the following several years post this decline, but eventually someone will recover. All right, so that looks pretty decent. Going down to the yield now, that's just dividing it by share price, Delta and Southwest. In fact, all of them that are positive look pretty strong in the double digits. As a comment, I used these three to come up with the average yield when I was forecasting forward for the free equity method. On a leverage basis, so here, very critical in these times, how much leverage do they have? Which one is the least levered? Here, Southwest Airlines, 1 times EBITDA to debt. That is a fantastic position to be into going into this downturn. That's by far and away the best performer. JetBlue and Delta, I highlighted in green because they are below our 3 times characteristic, but I would not touch United or American. They have too much debt, and I think they're one of the first to go under. If someone's going to go under, they'll be back in bankruptcy court to try to restructure themselves. So to avoid that and the painful dilution that comes with it, I'd stick to something that's less than 3x. Now let's go to the EBITDA multiple. EBITDA multiple is really just what they're trading for, and here I just wanted to point out that I used these 3 numbers here when coming up with the average market multiple to apply on our EBITDA valuation method. That's really the only reason I use that. All right, let's do the summary. Let's pick a winner. Which one do you think? What do you think? Delta, Southwest, United, American, JetBlue? Which one will survive? Which one will thrive? Nobody knows. I don't know. We are going to pick a horse. I told you we would, so we're going to pick one. But first I want to do a couple things. I want to update you for what I've read on the stimulus package, and that seems to be changing on a daily basis, so who knows. And then part of that is that the companies themselves have been saying that they're hemorrhaging cash, and they absolutely need that money. So I think they're fully dependent on getting the funds to survive. If they do, I think there are going to be fewer players going forward in the airline industry, and I think that the business travel itself will be largely affected by the prevalence of Zoom, Google Hangouts, the Slack meetings that are now the video conferencing. As people get more used to that, I can see people not flying. If it's ubiquitous, why expend the money in air travel? So my thinking on air travel in total is that total revenue for the industry will decline, and as a result you'll have a few less players in that industry, and those players should be able to survive, should be able to thrive. All right, so let's take a look. The top one that I think of right now that I'm going to go with is less debt, or is debt driven, and that's going to be Southwest Airlines. 1 times EBITDA, meaning they can take on a lot more debt to help themselves survive. They're going to borrow that money from the government. So I think that's the one that I think is in the best shape going into the decline. From what I can read on Southwest, it looks like the government has agreed to give them $2.3 billion of grants and another $1 billion in a loan. That loan comes with warrants that are converted into shares, or that are for shares, for $2.6 million. Now remember, I gave all share dilution an extra 10% for factors like this. This is about 1%, a little less than 1% of the outstanding shares. I'm giving more and saying you've got another 9 there that you can give up. Here's an example. Delta has already struck a deal with warrants, and those warrants are for 1% of the company. So that you could have lots more debt that they can use, and that debt could be given with kickers for equity. But basically, this is the update. $3.8 billion to Delta in a grant, 1.6 on a loan. We did Southwest. United Airlines, $4.5 billion in a grant, $5 billion in a loan. I hear they're asking for even more. I think if we look at United, Look at their debt ratio, right? Their leverage 3.4 times. That was above our metric, and you can see that they're asking for a lot of debt to help survive. American Airlines, $4.1 billion in a grant. That's a lot of free jack, and then 1.7 of loans. Finally, JetBlue coming in kind of in the least, 0.8 billion of a grant and 0.25 billion on a loan. So I don't know if any of this money is enough for them to survive. I did not look at Q1. I just pulled annualized numbers, and I said it's up to management team to survive, and it's up to the government to give them money to do so. If that does, and they hit the intrinsic value, this is the return. So again, I think I'm looking at Southwest as the least levered company, and I'm going on leverage my first choice. Second choice, I think it's a toss-up between Delta and JetBlue. Both of them have the next lowest debt. They both have double-digit EBITDA growth, and the return on cash is 6 times, is 5 times. I mean, these are very healthy returns. Southwest itself is 5 times your money if they survive, and if 10 years out. So this is my summary on airlines. Thank you very much for the comments. Let me know what you think. It's a guess if the government saves them. It's a guess if the airlines recover. But I do like the low debt, and I think it's an interesting risk-return trade-off. Again, I look at this as a binary. They survive, I get paid. They go down, I get nothing. If I'm going to lose everything, I need more than 20% of my money. I want 500% of my money, which is like what you're seeing here, 500, 600 times. Those are multiples of times of cash, and that is a much better risk-return trade-off if it really is I lose everything because they went out of business. Awesome. Thank you so much for your time. My name is Cameron Stewart, CFA. Thank you for watching Rational Investing. I look forward to your comments, and don't forget to subscribe. Bye-bye.